Caesars Palace, one of the most iconic properties in Las Vegas history, is in serious trouble. I'm talking about financial struggles, plummeting stock prices, getting kicked off the S&P 500, and a parent company drowning in over $12 billion in debt. When you think of classic Las Vegas, you think of those Roman columns, the marble floors, the opulence that defined the golden age of this city. But in 2025, behind that glamorous facade, things are looking pretty grim. So let's break down exactly what's happening with Caesars Entertainment and why this iconic property might be heading for a collapse. Let's start with the news that really made headlines. On September 22nd, 2025, Caesars Entertainment was removed from the S&P 500 index. Now, if you're not a finance person, you might be wondering why that matters. Let me explain. The S&P 500 is basically Wall Street's VIP list. It tracks the 500 largest and most successful publicly traded companies in America. Being on that list means institutional investors, pension funds, and index funds are automatically buying your stock. It's a mark of prestige, stability, and importance to the American economy. Getting kicked off that list? That's the corporate equivalent of being told you're no longer elite. Caesars Entertainment got replaced by Robinhood Markets, and the company was moved down to the S&P Midcap 400, which is for mid-sized companies. The reason for the removal was pretty straightforward. Caesars' market capitalization had fallen too far. They went from being valued as a large cap company to somewhere between $5 and $5.5 billion, which puts them squarely in mid-cap territory. Now here's why this matters, beyond just the symbolic blow to their reputation. When you get removed from the S&P 500, all those index funds have to automatically sell your stock. That creates immediate downward pressure on the share price. It also means higher borrowing costs because lenders see you as a riskier investment, and it means less visibility with investors. You've essentially been downgraded from the major leagues to AAA ball. For a company already struggling, this is brutal. Let's talk numbers, because the financial picture for Caesars Entertainment is rough. The company's stock has been absolutely demolished. We're talking down about 30% year to date in 2025 and down over 50% over the past 2 years. Some sources are even reporting drops closer to 35% over the past 52 weeks. If you bought Caesars stock 2 years ago, you've lost more than half your investment. That's catastrophic. Looking at the quarterly earnings, the story gets more specific. In Q2 2025, total company revenue was about $2.9 billion, which actually represented a modest 2.5 to 2.7% increase year over year. On the surface, that doesn't sound terrible, but here's the problem. The Las Vegas segment, which is supposed to be their crown jewel, their flagship operation, that segment actually declined. Las Vegas revenue dropped 3.7% in Q2, falling from $1.1 billion to about $1.05 billion. That's tens of millions of dollars in lost revenue from their most important market. Occupancy rates on the Strip dropped roughly 2 percentage points, which translates to about 27,000 fewer room nights. Same-store adjusted EBITDA, which is basically a measure of profitability, fell about 4% from $996 million to $955 million. These might seem like small percentages, but in a business this size, we're talking about massive amounts of money disappearing. And then there's the debt. Caesars Entertainment is carrying approximately $12.3 billion in aggregate principal debt. $12.3 billion. To put that in perspective, that's more debt than many small countries have. Every quarter, they're paying massive amounts just in interest on that debt. And that's before they even start paying down the principal. When your revenues are declining and your debt load is that enormous, you're in a very dangerous position. Now, to be fair to Caesars, they're not struggling in a vacuum. The entire Las Vegas market has been getting hammered in 2025, and that's a huge part of this story. The city has seen visitor numbers decline for 6 consecutive months through mid-2025, with some months showing drops as steep as 11% year over year. June 2025 was particularly brutal. The city saw about 400,000 fewer visitors compared to June 2024, which represents an 11.3% decline. The first half of 2025 saw overall visitor volume down about 7.3% compared to 2024. Convention attendance, which is supposed to be a reliable source of business, has been softer than expected. Hotel occupancy rates across the city have declined. Even casino gaming revenue, while showing some resilience in certain months, has had periods of significant decline. Some reports showed gaming revenue down 11% in May 2025. Harry Reid International Airport tells the same story. Airport passenger traffic has been down consistently, with both domestic and international travel showing declines. year-to-date airport traffic has been down roughly 4 to 4.5% compared to 2024. That's a lot of empty airplane seats, and a lot of people who decided not to come to Vegas. International tourism has been particularly hard hit. Canadian visitors, who have historically been one of the largest segments of international tourists to Las Vegas, we're talking nearly 1.5 million Canadian visitors in 2024, have dropped dramatically. Some airlines serving Canada have reported drops of 30 to 60% in passenger numbers. Air Canada saw about an 8% volume decrease. WestJet dropped 31%, and Flair Airlines got absolutely crushed with a 62% decline. Canadians contributed about $3.6 billion to the Southern Nevada economy in 2024 and supported more than 43,000 jobs. So losing that business is devastating. Mexican tourism has also fallen sharply, with some airlines reporting drops of over 60%. There's been a 19.6% drop in international passengers overall at the airport during certain months. Even the California drive-in market, which is Las Vegas's bread and butter, has softened. Traffic on Interstate 15 at the California-Nevada border has declined, which means fewer weekend warriors making the drive from Los Angeles, San Diego, or the Bay Area. Here's where things get really interesting, and this is something that's affecting Caesars maybe more than any other operator. There's been a massive shift in how people perceive the value proposition of Las Vegas. Simply put, people think Vegas has become way too expensive and isn't worth it anymore. Caesars properties in particular have been aggressive with pricing and fees. Resort fees at Caesars Palace, Flamingo, Harrah's, and Horseshoe are now up to $50 per night, plus tax. That's on top of your room rate. Restaurant prices have increased 25 to 40% since 2022. Parking fees have gone up. Dynamic pricing means that weekend rates can spike dramatically, so you might pay double or triple for a Friday-Saturday stay compared to a Tuesday-Wednesday stay. Everything just feels like a nickel and dime experience. The social media backlash has been brutal. You see comments everywhere saying Vegas isn't worth it anymore, that it's too expensive, that they used to go multiple times a year, but now they're not going at all, or choosing regional casinos closer to home instead. Workers on the Strip report fewer shifts and the lower tips, which tells you everything you need to know about how much money tourists are actually bringing and spending. Las Vegas Mayor Shelley Berkeley actually held press conferences calling on tourism industry leaders to re-examine their business decisions and make the city more affordable. When the mayor is publicly saying prices are too high, you know you've got a problem. While the market conditions are terrible for everyone, Caesars Entertainment has some specific problems that make their situation even worse. Remember that debt I mentioned? That $12.3 billion didn't appear out of nowhere. A big chunk of that debt came from Caesars going private in a leveraged buyout years ago, and then going public again. They've been trying to dig out from under that debt for years, and it's just not working fast enough. Caesars has been trying to raise cash by selling assets. They sold the World Series of Poker brand rights for about $500 million. They sold their stake in the Link Promenade for $275 million. But even selling nearly $800 million worth of assets barely makes a dent in $12 billion of debt. Here's another problem. Caesars Entertainment actually owns very little real estate anymore. Back in the day, the company sold most of their land and buildings to a real estate investment trust called Vici Properties in a sale-leaseback arrangement. So now Caesars operates the casinos and hotels, but they're paying rent to Vici for the privilege of using properties that used to be theirs. This was done to raise cash and reduce debt years ago, but it means they don't have the asset base they used to have. They're essentially tenants running casinos on someone else's property. The company has also struggled with its identity. They own everything from high-end strip properties like Caesars Palace to mid-tier places like Harrah's and Flamingo to budget options like the Horseshoe. Some analysts have argued that Caesars never really figured out who they wanted to be. They originated as Harrah's Corporation, which was great at running 3-star casino hotels for Middle America. Lots of volume, solid operations, good value. Then they tried to become a luxury powerhouse by acquiring Caesars Entertainment, and the company has been stuck in this weird middle ground ever since. They're trying to deliver 5-star experiences, but with 3-star operations and pricing that's somewhere in between. Upper-income tourists who want true luxury go to Wynn or Encore or Resorts World. Middle-income and budget tourists who can't afford these inflated prices either stay home or go to regional casinos. Caesars is caught in no man's land. Not quite luxurious enough for the high end, but too expensive for the mass market. The struggles at Caesars Entertainment aren't just impacting shareholders and executives. They're having real effects on workers and the broader Las Vegas economy. Casino workers, restaurant staff, and hospitality employees at Caesars properties have reported reduced hours and fewer shifts. When occupancy is down and there are fewer guests on property, you don't need as many dealers, servers, bartenders, or housekeepers working. Tips have declined because there are fewer guests, and the guests who are there are spending more conservatively. In a city where many hospitality workers rely heavily on tips to make ends meet, that's a real problem. At the same time, the cost of living in Las Vegas has continued to rise, so workers are being squeezed from both sides. The ripple effects extend beyond just Caesars properties. Las Vegas is a tourism-dependent economy, and when the big casino operators are struggling, that affects everyone. Local businesses near the Strip feel the impact. Retailers, transportation companies, entertainment venues, all of them depend on a healthy flow of tourists with money to spend. Southern Nevada's economy generated about $85 billion in total economic impact from tourism. When tourism declines by 7 to 11%, that's billions of dollars not flowing through the local economy. That means fewer jobs, reduced tax revenues for local and state government, and less money circulating through the community. To their credit, Caesars Entertainment isn't just sitting around watching things fall apart. They've been trying to respond to these challenges, though whether their efforts will be enough remains to be seen. In August 2025, Caesars participated in a citywide, fabulous 5-day sale promotion, offering reduced room rates and food and beverage packages to try to drive traffic. They've been rolling out early booking discounts and multi-night stay promotions. They're doing more flash sales and special offers than they used to. The company has also started focusing more on local residents after years of largely ignoring that market. They're offering dining deals and staycation packages specifically for Nevada residents. This makes sense because locals provide steady, reliable business, especially during weekdays and off-peak periods when tourist traffic is lighter. Caesars has also been making noises about potentially selling more assets or stakes in various properties and brands. On the digital front, Caesars Digital has actually been a bright spot. Their online gaming and sports betting operations have shown growth. The company is pivoting to focus more on digital and regional markets where they're seeing better performance. CEO Tom Reeg has been publicly optimistic, saying he expects Q3 2025 to be soft, but projects a strong Q4 heading into 2026. He's citing a robust group calendar with conventions and major events like Formula One returning, CES 2026, and other major shows that should drive occupancy and spending. The company is banking on a rebound in the second half of 2025 and into 2026. So here's the big question. Is Caesars Palace actually going to collapse? Are we looking at another bankruptcy? Let me be clear about something. There's a big difference between struggling and collapsing. Despite all these problems, Caesars Entertainment is still generating billions in revenue and is still profitable at an operational level, even if those profits are being eaten up by debt service. The company went through bankruptcy back in 2015, and that restructured a lot of their debt. They emerged from that bankruptcy and have been operating since then. Could they go through another bankruptcy restructuring? It's possible. Some analysts and commentators have speculated that if things don't turn around within the next few years, another bankruptcy could be on the table. But bankruptcy doesn't necessarily mean the casinos close their doors. It usually means restructuring debt obligations, potentially bringing in new ownership or management, and reorganizing the business. Even if Caesars Entertainment, as a corporate entity, runs into serious trouble, those properties would likely be sold or transferred to new operators rather than being demolished or abandoned. What we're really looking at is a crisis of profitability and sustainability under the current corporate structure with the current debt load. The question isn't whether Caesars Palace will cease to exist. It's whether Caesars Entertainment, as we know it, can survive in its current form. The Caesars Entertainment situation tells us something important about Las Vegas and the broader economy. For years, Vegas was seen as recession-proof, constantly growing, always bouncing back. And to some extent, that's still true. The city is resilient and adaptable. But what we're seeing in 2025 is that there are limits. You can't just keep raising prices indefinitely and expect customers to keep coming. You can't nickel and dime people with fees and expect them not to notice or care. You can't rely on the same old playbook when consumer preferences and behaviors are changing. Regional casinos have gotten better and more sophisticated. Online gambling and sports betting give people options they didn't have before. Younger generations travel differently and have different priorities than previous generations. Las Vegas built its reputation as a place where you could have an amazing time without breaking the bank. The buffets, the cheap rooms during the week, the free drinks while you gambled, That value proposition is what made Vegas special. When that value proposition disappears and Vegas becomes just another expensive destination, you lose something fundamental. Caesars Entertainment, more than maybe any other operator, seems to have miscalculated what their customers want and what they're willing to pay for. They pushed too hard on pricing. They didn't differentiate their properties enough. They got stuck in the middle between luxury and value, and now they're paying the price. If Caesars wants to avoid a worst-case scenario, they need to make some major changes. First, they need to seriously address the debt situation. Whether that means another round of asset sales, debt refinancing, or even another bankruptcy restructuring, they can't keep operating with $12 billion hanging over their heads while revenues are declining. Second, they need to fix their value proposition. That might mean reducing some fees, offering better promotions, or finding ways to make people feel like they're getting a fair deal rather than being constantly upcharged. The social media and public sentiment around Vegas being too expensive is a real problem, and Caesars needs to be part of the solution. Third, they need to invest in creating reasons for people to visit. That means entertainment, unique experiences, attractions that draw people in. The properties that are thriving in Vegas are the ones that give people something they can't get anywhere else. Finally, they need to continue building their locals business and their digital operations, which seem to be the areas where they're actually seeing some growth and success. I've been following the Vegas market for a while now, and the Caesars situation is genuinely concerning. This is one of the most iconic brands in casino gaming history, and watching them struggle like this is tough. The Roman columns at Caesars Palace, the fountain out front, the Forum shops, these are legitimate Vegas landmarks that have been here for decades. But the reality is that Caesars Entertainment made some serious strategic mistakes. They took on too much debt. They sold their real estate. They pushed prices too high, too fast. They didn't adapt quickly enough to changing market conditions. And now, they're in a position where they don't have a lot of margin for error. The broader Las Vegas market downturn is making everything worse, but Caesars is particularly vulnerable because of their specific circumstances. If the tourism market rebounds strongly in late 2025 and into 2026, Caesars might be able to stabilize. But if the slump continues or deepens, we could be looking at some very difficult decisions ahead. I don't think Caesars Palace as a property is going to disappear. It's too valuable, too iconic, and too well located. But Caesars Entertainment as a company, they're in real trouble. Whether that means another bankruptcy, a sale to new owners, a breakup of the company, or some other restructuring, something's probably going to have to give. We're watching this situation unfold in real time, and it's going to be fascinating. Vegas has seen properties come and go over the decades. We've seen legendary casinos imploded to make way for newer, bigger resorts. But somehow the idea of Caesars Palace struggling feels different, because it's such a central part of Vegas mythology.